Okay, so here's a quick overview of Case 5, the cost of capital, or the weighted average cost of capital case. We're going to do a couple of other videos that get into how to answer some of the questions in the format, and I'll post an example to Blackboard of this spreadsheet schedule and graph that you'll need to do for this case. And I'm also adding a question to the case that gets a little more into the WACC computations and so forth. So I'll post additional case questions to Blackboard that you need to make sure you get and look at and answer, because that's really the main part of the case. This case, like the other one, make sure you read all this to find out exactly what you're doing and why you're doing it. You get down to the table, just cross that table off. Don't try to use it. Questions we're doing don't pertain to the table, so don't try to use this table for anything. Just cross that out. And the main thing you need to look at with the case are these notes or whatever they have down here. They talked about talking about the long-term debt, and it's BBB rated, and their tax rate. Here's information about the preferred stock. This is information about their common stock. And you can see on this case 5 that I posted, I guess this is okay. I went ahead and crossed out some things that I don't want you to look at and that are kind of confusing. One of the main things is in this note 6, talks about the current yield on long-term bonds. T-bonds is 7%. That's the risk-free rate. And then all this kind of stated funny in the case originally. That's probably why I blacked this out. It states, what this basically says is the market risk premium is 6%. It says 6 percentage points above the risk-free rate or something. But what all this is saying is the market risk premium is 6%. A-rated companies 9%. And then down here, wherever it talks about depreciation, is what was written here. Just ignore all of that. Don't worry about anything that has to do with depreciation. Don't let that confuse you. And then talks about the flotation cost on common stock here. And then 10 is where it gives you your capital structure. It's 30% debt, 10% preferred stock, and 60% common equity. Okay, it says common stock here, but don't get confused. This is the common equity portion, where it might be common stock that they issue, or they'll use up retained earnings first. So retained earnings is the first part of common equity, and then if they use up all the retained earnings, then they go to common stock. And maybe I'll do a video and explain that process a little bit more, because you may not have done that in your previous classes. On the questions, question 1 is just a basic it's a concept type question, no big deal there. And all the other questions, a lot of them, it looks like a lot of questions, but they're just having you calculate cost of debt, cost of retained earnings, cost of preferred stock is all it is, a simple calculation. Like here, what is your estimate of cost of debt? Make sure you kind of explain what cost of debt is and any formulas you might need, and then show the calculation like I've been stating. And then make sure you answer the other questions I have marked, just A, B, and E, I believe. Don't worry about the other ones. Question 3 is just, what is cost of preferred stock? Explain what cost of preferred stock is, show the formula, show the calculation, and state your answer. Question 4 is a concept question about retained earnings, and then basically, what is the cost of retained earnings using the CAPM approach? There's several different approaches of finding cost of retained earnings. This one has you do it with the CAPM approach, and then has you answer C part, which is another concept type question. And question 5 is, what's the cost of retained earnings using the DCF approach? That's the Gordon constant growth model approach, basically. Show the formula, show the calculation, explain how you do it. This question down here deals with the retention growth model. You need to probably find that in your book to figure out how to do that if you haven't done it before. So make sure you look at that.